Have you ever tried to navigate a new city without a map? You take a few turns that feel right, then suddenly you're lost because all the streets look the same. Trading feels exactly like that when you don't understand the market structure. Market structure is the map. It tells you where the price has been, where it's likely to go, and which paths are just pretty detours that leads nowhere. When we say market structure, we're simply talking about the sequence of highs and lows that price prints over time. If those highs and lows are climbing, the structure is bullish. If they're dropping, the structure is bearish. If there are sideways, the structure is ranging. That's it. The trick is training your eyes to see the story, not just the candles. Think of it like hiking a mountain trail. If each ridge you reach is higher than the last, you're definitely going uphill. That's an uptrend. Higher highs and higher lows. If each ridge is lower, you're going downhill. Lower highs and lower lows. If you're circling around the same lookout point, that's a range. Here's where most beginners get tripped up. Not all highs and lows are equal. Some are the big swing turns you can't spot from across the room. Others are just tiny jumps along the way. The big turns are what we'll call the external or swing structure. The tiny bumps are the internal noise. A good way to separate them is to ask, if I squint my eyes, which turns are still clearly visible? Those are your swing points, and that's the skeleton of the market. Let's put this into a top-down routine we can repeat. First, pick a higher time frame, the daily or the 4 hours, to define the external structure. Mark the swing highs and swing lows if price printing high highs and high lows. You carry a bullish bias. If you're printing lower highs and lower lows, your bias is bearish. Second, drop to a lower time frame, like the 15 minutes over the 5 minutes, to time entries using the internal structure, which is just smaller versions of the same story. Highways first, then side streets. Now, let's talk about two words you'll hear all the time: break of structure and the change of character. Now, let's talk about two words you'll hear all the time: break of structure and change of character. A break of structure means the trend is continuing. In an uptrend, if price takes out the previous swing high with a convincing move and closes above it, that's a bullish break of structure. In a downtrend, taking out the prior swing low is a bearish break of structure. Think of it as the trail confirming you're still climbing or you're still descending. A change of character is the first sign that the rhythm might be flipping. In a rising market, if price stops making higher highs and then breaks a prior higher low instead, that's your something change moment. It doesn't guarantee a full reversal, but it's the market tapping you on the shoulder and saying, pay attention. Because price moves in waves, you'll often see a break of structure of the higher time frames, while the lower time frames deliver many tiny change of character moments in both directions. That's normal. The skill is aligning the small with the big. If the daily is bullish, you prefer taking the lower time frame, shift that point back into the daily direction after a pullback, not the ones that fight it. Let's bring in liquidity because it explains why structure sometimes looks like lies. Swings highs and swings lows collect orders. Buy stops sit above highs, sell stop below lows. Before continuing, price often wicks past those obvious levels to grab liquidity, then closes back inside and goes the other way. That wick is not a real structure break. What matters is where the candle closes and whether we get follow through. Two practical rules to reduce confusion. 1. Treat structure with closes, not just with wicks. 2. Require context. After a break, watch for a retest to hold or for momentum to continue. If it breaks, retests, and holds, that's far more trustworthy than a single spike. Now, let's put structure to work with a simple repeatable plan. Step 1. On a higher time frame, mark the last real break of structure and decide the current rhythm, uptrend, downtrend, or a range. Step 2. Mark the nearest swing points that matters. The last higher low that must hold for bulls, or the last lower high that must hold for bears. Those are your invalidation lines. Step 3. Drop down and wait for a pullback. On the pullback, look for the lower time frame structure to shift back into the higher time frame's direction. That's your timing signal. Step 4. Place your stop beyond the swing. That proves you wrong, and aim for the opposite structure. Prior swing high-low, the edge of the range, or a clean imbalance that price tends to revisit. Let's walk through an example. Imagine the daily chart is in a clear uptrend, higher highs and higher lows. Price just broke above a significant swing high. That's your bullish break of structure. You now expect a dip. On the 15-minute, price pulled back into a prior demand area and stopped falling. Internally, you see a tiny downtrend of lower highs and lower lows. Then, boom, price flips. It breaks a 15 minutes lower high and holds above it. That's your entry cue in line with the daily map. Your stop goes under the daily higher low and under the 15 minutes level that turned. Your first target is the previous daily high. Your second is the next logical liquidity pocket above. What about the ranges? A structure inside a range is like reading in place, up, down between two walls. The external structure is neutral until one side breaks with a close and a hold. Internally, you can still trade the edges, but your map says treat middle moves with suspicion. Here is a rule of thumb that saves accounts. A structure first, everything else second. Indicators lag. Structure is the raw sentence the market is writing. If the higher time frame is printing higher highs and higher lows, you don't need a dozen signals to prefer longs. If it's printing lower highs and lower lows, you don't need permission to prefer shorts. When a structure is mixed or unclear, your job is not to be a hero. Your job is to preserve capital until the map is actually readable. Let's talk about some common mistakes that are very human. One is marking every tiny dump as a new swing. Your chart becomes an spaghetti and you lose the plot. Another is calling every wick beyond the level a break, then getting fakeouts constantly. The third is mixing time frames, bullish on the daily but shorting every 5 minutes, deep in the middle of a pullback. Clean this up and the structure starts to sink. You'll also hear people talk about premium and discount, buying pullbacks in the cheaper half of a swing, selling rallies in the expensive half. If that idea helps you, great. Splitting a swing with a midpoint line can keep you patient. You don't need to over-engineer it. The core is unchanged. Trade in the direction of the external structure. After a pullback, when the internal structure flips back in your favor. Finally, let's stitch together the whole story in one breath. The market writes sentence with highs and lows. The grammar is simple. Higher highs, higher lows means up. Lower highs and lower lows means down. Back and forth means a range. A break of structure says, same sentence, keep going. Your job is to read the higher time frame sentence first, then zoom in to catch the words that align with it. Then price pulls back, wait for the small letters to turn in the same direction as the big headlines. Then take the trade with your wrist tucked behind the last swing that would prove you wrong. Aim for the next meaningful word in the story. The prior swing, the range edge, the obvious pull for orders. If the story becomes messy, you put the book down and wait for a clearer chapter.